Okay, welcome back to the Success Money Marriage Podcast. I'm your co-host, Steve Siebold.
And I'm Dawn Siebold.
In today's episode, we're going to talk about learning how money works.
My favorite topic.
It's a big topic. It's something you have to have as a business owner, but as it relates to working together, money will most likely be your biggest argument. Cash flow. Cash flow is the king, obviously. It's the lifeblood of any business. And if you don't have cash, you're dead. It's over, you know? And so we're going to talk about some of the basics of how money works that a lot of people that we've talked to over the years, entrepreneur friends of ours, people that want to be entrepreneurs, couples, single people, whatever, they don't know these basic things.
Right.
And so we're going to talk about just basically the things you need to know. And believe it or not, we're going to cover it in a very short show here. Basically the three things
If you don't repeat yourself over and over, we will.
You're so irritating. We just did
one on patience. We just did one on patience.
But you're so irritating.
I'll stop. I won't say it again.
You'll stop. 37 years. You're going to 38 years.
No.
Now you're going to stop? Gee, thanks for that.
But I also don't want the audience.
38 years, you stop for like 10 minutes.
I don't want the audience to think that not understanding about money is their fault. It really isn't, because we weren't taught this in school.
We're not taught in schools, typically.
And our parents, if you had a parent that taught you about money, congratulations, because my mother worked for a bank. And for her whole entire career that I remember. And she never taught me about money. I knew she was saving, but it was not like we sat down, we had that conversation, here's how you save money, here's how you... So for those of you who are out here thinking, I have never heard these concepts, you're not alone, and don't feel bad, because most of us haven't heard these. Yeah,
they're things that you'll understand them just in a few minutes. They're things that most people have never understood. And, I talk to the media almost every day, specifically the financial press, because I've written 4 books on, around the topic of money, psychological concepts around money. And a lot of the financial people don't know either. Maybe not real financial people, but financial reporters.
Right.
Anchors of shows, financial shows, those kinds of things. So let's get right into it. So why don't you explain to people the concept that Albert Einstein called the eighth wonder of the world? The word most closely associated with this concept is magic, although it's math, not magic. And that concept is?
Compound interest.
So explain compound interest in a way that people can easily digest it.
Yeah. So compound interest is you put money in a vehicle, a contract, or you can put money in the bank, which is not where rich people keep their money, but you can do that. And you could put your principal in, your deposit, basically, is $100, and then it compounds. It has compound interest, so it's interest on interest. So let's say you put $100 in and you get 10%. Now you have $110, right? So it's interest on the $100. So you get the $10 plus the $100. And then the next year you get another 10%. So you're timesing that 10% interest times 110, not your original 100. So it's interest on interest. And what's really amazing and probably very sad is that most of us learn compound interest for the first time when we either buy our first car or we get our first American Express, and we have a negative feeling about interest on interest. It works against us. Yeah. I'll never forget that time we had just gotten married, and we would go out to eat once a week. We would go to Chili's, and I remember we put it on our American Express,
right.
And I just remember looking at the American Express bill, going, "Okay, Steve, if we don't pay the principal off and the interest, we're just keeping getting interest. There's no way we can financially pay this credit card off.
Catch up. We'll never
we can't catch up.
You saying that.
We cannot catch up." And the same thing with your car payment. You buy a car payment and they say, well, it's going to be $300 a month. Well, that's your payment without the interest rate. So you think I can handle $300 a month. So unfortunately, a lot of us learn compound interest, and we have a negative relationship with it because we're behind the 8 ball. And I can't tell you how many student loans that are having a high interest rate that compounds. So it's the same thing. You don't pay off that balance every month that compounds, and eventually it just gets so far out of hand that a lot of people need professional help getting those debt bills down because of the interest on interest. So, but if you have that interest working for you, I love the way you say it. What the rich do is, we use that, get their money working for them. And basically, you tell the story, they're like employees, right? You throw them out there and get them interest on interest, and they work for you.
Yeah. Compound interest either works for you or against you. For the masses, for the middle class, well, you were talking about back in the day when we had no money. I remember we were that one time you said we're $13,000 and this is a long time ago, $13,000 in when $13,000 was more than it is now, $13,000 in debt, and we're paying, it was like 23% interest. And I remember you saying that. I remember you saying there's no way we can catch up because we can't afford to pay more than the minimum payment. I forgot what that was.
Right,
I mean, what they called it. Minimum payment. We can't afford it. There's no way. We didn't have any more money. And when you said we go to Chili's, we'd put it on the American Express or the Visa or whatever it was because we couldn't afford to pay cash. I remember we had a friend that paid cash. It was $22 usually for the meal. You know, this was 30
back in the
years
80s,
ago.
Early 90s.
Yeah, early 90s. Yeah, probably late 80s. Probably late 80s.
You could get a full 2 meals and an appetizer and Diet Cokes for $22.
$22, and we had these neighbors that were friends of ours that were making more money, and they would pay the $22 in cash plus tip. We're like, who has cash?
Who does that?
Who has $22 in cash per tip?
Every week.
Remember we talked about every week they do this, and we were like, there's no. I mean, it might sound funny to people that have a lot of money, but it's not when you have no money.
Right.
I mean, it really is. So compound interest works for you or against you. Again, for most people, it's working against them. But for the wealthy, that's their favorite thing. Because if you've ever seen a financial illustration, if you haven't, I recommend you do. Work with a financial person. If you don't have one, we have an organization of 10,000 people in 50 states that we do these things every day. But if you have a financial person that you really trust, work with them and ask them to run, if you've never seen one, run a financial illustration with compound interest over a period of 10, 15, 20 years. And you won't believe how it grows.
It's crazy.
That's why people say it's like magic. It's hard to believe until you actually do the calculations yourself and prove it. You know, we wrote a book, Tom Matthews, one of our business partners, and myself, we wrote this book called How Money Works. And if you're watching, you can see this on the tape. But if you on camera, if you are listening to it, it's called How Money Works. Stop Being a Sucker. And it's the number one selling financial book since 2020. It's the number one selling financial book in the United States. And it's very, very simple. It's a short read. It's like an hour long. I mean, it takes like an hour to read it, basically. Maybe an hour and a half if you're a slow reader like I am. But basically, we just cover things like compound interest and simple things that once you understand it, you want to get it working for you. And what Dawn's talking about is what I was talking about in a speech I gave last night about this. I said, the wealthy, one of the things we learned from them, interviewing them for 38 years, is they treat their dollars like employees that never take a break, never take a vacation, never stop, never sleep. They just go out there 24/7. Those dollars are working for you, and they're creating more money for you. And one of the things that people ask in the media all the time is about how do the wealthy, what do they have big salaries, whatever. They may have big salaries, they might not have big salaries. They might be getting dividends, they might not be getting, probably all those things put together. But the rich don't live off of any of those things.
No.
They live off of interest.
Right.
Interest. That's it. That's how the rich get richer.
Very seldom touch the principal.
They never touch the principal. Well, yeah, very seldom touch the principal. They are freaks about it. They buy things on interest. They live on interest. It's all interest. So they're getting richer every single day. Whether their income is almost irrelevant because it's interest on interest on interest, and it just compounds over time mostly because they understand the concept. The good thing is you don't have to be rich to benefit from compound interest. You just have to understand really how it works. And 99 out of 100 people really, they think they understand it, but they really don't because they've never seen the illustration where it jumps. It's just normal. It's pretty normal for the first couple of years. And all of a sudden, 10, 15, 20 years down the road, it starts leaping by leaps and bounds to the point where you look at it. Clients, we have lots of clients all over the country that we work with, we help them with their finances. And they say the same thing every time when they're new to compound interest. They say, there's no way these numbers can be, there's no way I could have that much money over 20 years. There's no way there's no way. And we say, well, that's the magic of compound interest. It's unbelievable.
Well, I think if people were taught this way of thinking about compound interest earlier, they would have understood it. But if you ask the average person on the road, explain compound interest, they fumble a little bit, I think, because they've had such a negative relationship with compound interest with their credit cards. Because you truly, if you don't make more than a minimum payment on your credit card, you will never pay it off.
Right.
They plan that. I mean, and some of the credit cards go from 17% to 22%, and they always give you a minimum. They purposefully give you a minimum. If you don't make extra payments to the principal, you literally will never pay it off. And so I think when people think compound interest, they're thinking that credit card or that car payment or that mortgage payment.
Right.
And so I think that's why they can't explain it, because all they see is that they're just having to pay more and more. But if we were taught this from the very beginning and how it could work for you, then everyone would be able to explain it, because we would start investing when we were 15 or 16. And now we see bank statements going, I love compound interest because I'm not doing anything. I'm letting that money sit in the vehicle and I'm watching it grow every single statement. Then everyone would know how compound interest, and everyone would want to know and share it with other people.
Yeah.
And I definitely think that's why most people don't really, truly understand compound interest.
Yeah, once you actually see it in action through an illustration, the best way, wouldn't you say, is a financial illustration?
Oh, definitely.
That's the best way to understand it, because you can't believe it when you see it. Again, in the beginning, it's like the old saying, probably a lot of people probably heard this, would you rather have $1 million or a penny a day doubled every single day? And that's an old thing, right? And if you've ever seen the numbers on that, by day 26, you don't have hardly any money. And all of a sudden, day 27, day 28, it just starts going just crazy. And it's way more. It's like $3 million.
It's so
if I remember right. It's crazy.
It's so crazy.
And people go, I want the $1 million, a penny a day, it doubled every day for 30 days. But it actually compounds so much that you have over $3 million.
Yep.
And so once you understand that, now going back to being in business with your partner, this is something you both have to understand, because when you make financial decisions together, now you're saying, okay, well, let's make a capital investment on, let's invest in a, whatever, a new building on the property or something like that. Okay, how much is it going to cost us? Well, let's say it's a small building. It's to make it easy, $100,000. Okay, well, Dawn and I, because we work in the financial field every day, what we're thinking is not $100,000.
No.
What we're thinking is, okay, we put $100,000 into that. Now we have a building. Okay, but can we afford the $100,000? That is not the conversation we have.
No,
because we understand compound interest. Now, follow me on this. If you're lost, if you're thinking, I don't get where you're going with this. It can be a little. It's nonlinear. It's a little confusing. It can be, but once you lock it down, you'll never be the same, right?
You can't. You can't
go
ever
back.
be the same.
You can't put the genie back in the bottle once you understand.
You can never buy something again without thinking of this concept.
Yeah.
So walk them through it. Walk them through it. Keep going.
Yeah.
They're going to miss it.
So now we say, well, do we have no? If we didn't understand compound interest, and let's say we would say, okay, well, can we afford the $100,000? Can we afford the money to pay for the building? And then the answer would be yes or no. But when you understand compound interest, what you say is, okay, let's say, Dawn, we don't do the building. We don't take the $100,000 there. We take the $100,000 and we put it into a financial instrument. And let's say that financial instrument's rate of return is 9%, okay, or 10%, like the market average is pretty much across the board over, 100 years. So let's say, to make it easy, we'll say it's 10%, okay? So at 10%, 10 years from now, with that compound interest rate locking in monthly, okay, those gains locking in monthly, getting a 10% rate over 10 years, that's how much money would we have if we put the money in that $100,000 in the financial instrument as opposed to the building. Okay, 10 years from now, we have a building still, which is good. For whatever reason, we're going to have the building. Okay, hopefully it makes some money. Or we could, how much money would we have? Would it be $105,000 or $150,000? It would be, we don't have the illustration in front of us, but it would be a giant number.
Yeah, so just let me clarify, for those of you who are not in the industry, an illustration is just simply plugging in numbers in a software package that you can do online, just like kind of figuring your mortgage. So you just plug in, if I want to put in $300,000 at 6% interest, the illustration would show you what compound interest would do over 20 years.
Yeah, you just need a compound interest calculator, basically. Right. You can do that too. I mean, you just they have them online.
You can do it online.
Yeah, it's online for free. You won't believe it. So take the $100,000, do it over 10 years. Now, after 10 years, we either have a building or we have this $100,000 that's been compounding. Interest has been compounding for 10 years, locking in monthly gains at a rate of return of, say, just for argument's sake, 10%. Well, I don't have it in front of me, but it would be a substantial number. Let's call it $200,000. Okay, I would say after 10 years, it's probably somewhere in the neighborhood. It's more than you think typically. Let's say it's 20 years. Then do a 20-year run, okay, with it. The building we have at 20 years, or we have the $100,000 compounding at 10% over 20 years. Now, whatever that number is, that's the real cost of the building, not the $100,000. Now the question is, so when we have this conversation, we run it through a compound interest calculator and we say, let's say it's $300,000 over 20 years. Can we afford it? Is the building worth $300,000? Because if it's not, we can do this for 20 years and have the $300,000 in cash. Now we make a totally different decision. It's like when people buy cars, like right now the hot car, or one of the hot cars, is the Corvette, because they're really cool cars, right?
Super cool.
They're super cool, but they're
super cool.
They're a little
looking.
pricey too. Every time they were supposed to be 60 grand, and every time I see one, it's over $100,000. Call it $100,000. Okay. Can you, is it $100,000 or is it more over a 10-year
Even
period?
if you paid cash.
Even if
so
you paid
I'm not
cash.
saying if you're taking the,
Makes no
not
difference.
taking,
Oh, yeah.
no,
Right.
I mean, that's even
It's
worse.
a lot more if you
it's
don't
even
pay
a lot
cash.
more.
I'm trying
We're
to
talking
think
about you
about
paid
that, yeah.
cash for $100,000 and now you've got this really super cool car, which may be worth it to some people.
Sure, if you got a lot of money.
If you got a lot of money. But what that $100,000 could do for you over 10 years at 10%.
Right. That's the real cost of the
That
car.
can set your whole retirement up.
That's the thing. So it's like
Yeah.
these things we just spend money on, you think, well, it's only this much. No, it's not, because the opportunity cost of the car or the building, in this case, in these cases, is the real cost, the actual cost. So when you have this conversation with your partner, you're talking about real costs in the real world as opposed to what it looks like, what most people that don't understand compound interest really think the cost is.
Right.
This is how the rich get richer.
And
you
I
guys.
think this show should just be on compound interest because I don't
right.
want to go too far and I don't want to go too long. But I love your story when
You're changing
when
the
you
show,
talk about
like right in the middle. Like you can't do that.
Hunter.
You can't keep going to Hunter.
Hunter said I could. So will you tell him the story?
You're very bossy. You're very bossy. You always have been.
Yeah.
Actually, one of
Okay.
our clients sent Dawn a thing, those things on the desk, like you have you like your name, the nameplate. She sent one that says Miss Bossy Pants. No, Miss Bossy. Miss Bossy Pants or just Bossy?
Just Bossy.
Miss Bossy. And Dawn's like, I wonder why she'd send this to me. I go, gee, I have no idea.
Someone
that's
needs
crazy.
to take charge of this show.
Yes, there you
All
go.
right.
See, there it is right there. We really ought to put it in the front
tell
of our table
them
here.
the story that you explained when you're on stage about when we go in and make deposits. Do your $100 deposit. And how much you're getting on the $100. And most banks right now are less than 1%. And then what they do when they give you a credit card.
Yeah,
I
sure.
love this story, guys. You're going to learn a lot from
Well,
this.
I did this on stage last night, but it's an old story, but that I've told for a long time. But basically, what we tell people, and I say it in the media all the time, and the media doesn't usually like it. But rich people don't put their money in banks. They just don't. Oh, do they have bank accounts? Of course, because it's very convenient to have access to a small number, small amount of cash in a bank for ATM reasons or whatever like that, just for convenience. But their real money is not in a bank. Why? Because banks don't pay any returns. Their returns are terrible. The average return right now as we speak is 0.05%. 0.05. Okay, our bank, and we can say the bank, because
Right.
what are they going to do? So
we're
it's-
the biggest suckers of
we're the
everyone
biggest
out
suckers
there.
ever. Is Regions Bank, because we have hardly any money in it. But Regions Bank is our bank here in Atlanta here, and they're 0.01. That means for our money to double, it takes 7,200 years. They're paying us nothing. They're basically getting our money for free.
That's the next.
I know it's the next thing, but you changed the show.
Okay.
I had this whole thing planned out.
Okay.
Anyway, so Miss Bossy Pants changed the show, so now I've got to go a different direction. But anyway, this example we say is, okay, I'm going to go into a bank and I'm going to open up a passbook savings account. Like most people do, right? This is what my parents did. Their parents did. I mean, pretty much the FDIC guarantees at $250,000. I can't lose my money. So I go in and I'm feeling really good. I'm going to open up my savings account, feeling good about myself. And they say, yes, can we help you? And I say, yes, I'd like to make a deposit. Matter of fact, I'd like to open up a passbook savings account.
Yep.
And they say, well, fantastic, Mr. Siebold, how can we help you? I said, well, I have a deposit. I have some cash. And it's, I don't want to say too much here, but it's a large amount. And they say, well, we're ready for large amounts. If we have to back up the truck, we will. And I say, well, you may have to. And here it is. How much would you like to deposit? I say $100. And they say, okay, we're prepared to take that kind of money in. So I have 20, 40, 60, 80, right? 100. And they take it and they give me in exchange a little book, a little passbook savings account, right? And then I got my name in the account. I'm feeling pretty good about myself. And they say, well, we're just so glad to have you as a new customer, in the Passbook program. And as a result, you are now VIP.
Yes.
Which I expected for $100 deposit, right? And they say, matter of fact, you've qualified as a VIP customer. You've qualified for our Regions Bank credit card program. And you have a $5,000 limit because you are a VIP. And I said, well, I appreciate it. I kind of expected that with that level of deposit. And they say, yeah, fill it out. And then you have $5,000. You can, pay anything you want on it. And, thanks for coming to the bank. And I'm walking out and there's a bowl of suckers right there. There's a bowl of suckers. And what kind of suckers are they? Well, they're dumb suckers. They're trying to tell you.
They're trying to
He's trying to tell you you're being a dum-dum, but we don't get it. I take a butterscotch and I say, can I have 2? They said, well, $100 deposit. You can have as many as you want,
Right.
So I take 2 and I'm feeling pretty big. It's thank you, Mr. Siebold. And they're laughing. And I'm thinking, we're just happy to have me as a customer, I guess, right? So what do they do now? Okay, I'm the sucker that put the money in the bank at 0.01%. But it turns out, Dawn, that there are many suckers.
I know.
You know how much money is in passbook savings accounts right now, 2022? $10 trillion.
Sitting there. Making no money.
Now, the bank happens to be making a lot of money because what do they do? Well, that credit card I filled out, that I got the $5,000 limit, you know what the percentage rate is right now? Average 17.4%. So here's what they did. Just think about this. Banks make nothing.
Brilliant.
It's absolutely genius. It's a total ripoff, but it's genius. They make nothing. They produce nothing. They take our money in, give us nothing for it, basically, or pennies on the dollar in interest, and then they loan it back to us in the form of a credit card or a home loan or a car loan or any other home equity loan, whatever. And we get 0.01 and they get 17.4.
Right.
Can you imagine why banks are rich? They're the richest entities in the history of the world. The financial industry is $1 trillion industry. They make the spread. That's why they're so rich. They have no cost hardly. And so they're loaning our money back to us. And we say, and I got my passbook savings account. I think I'm a financial wizard and I'm a complete idiot. But I'm not the only sucker, it turns out. Almost the entire country is doing the same thing. $10 trillion. The whole economy is only $17 trillion. That's an enormous, it's just an unfathomable amount of money.
People don't know
because we're not taught. So we're all happy that we're at the bank. Rich people don't do that. They don't go to banks. That's crazy. Once you understand these things, the problem is, like you said, it's not our fault. They don't explain it to us. Why? The financial lobby doesn't want it taught in schools. They've been blocking it for years because the more ignorant we are, the richer they get. It's a ripoff. So if you're feeling angry right now, you should be angry.
Right.
It pisses you off because you realize you're being ripped off and you don't really know it until someone teaches it. That's why we wrote this book, This How Money Works book, because we wanted to really educate people. And the thing sold 500,000 copies or, just a little over that now. And because people are understanding it and they're getting angry at the banks and they're working with financial professionals, which we highly recommend, whether it's us, our firm, or it's someone that you trust and you like and all that, whatever it is. Don't try to navigate this alone. The concepts are simple, right?
Yeah, I would get the book first.
But you need help.
If you have someone that you enjoy working with, or it's a friend or a relative that's a financial advisor or in the financial services industry, I would definitely get the book, read the book, educate yourself, because the more educated you are, the better questions you'll have for that person and the better decisions you'll make. And it doesn't take long to read it, although our niece last night, I gave her one of the books, and she's like, "Can we have it on audio?" I said it only takes an hour and a half to read.
Yeah, right. Yeah.
So for those of you who don't like to read, it's just an hour and a half. We do not have it on audio, but I would definitely just closing out what I have to say about this is if you read this book, chances are you'll never make a bad financial decision again, at least without knowing the consequences of your actions.
Yeah, if you make one, you'll do it on purpose. You'll say, "Well, I just want to buy the Corvette because got 6 months to live and I want to buy the Corvette." Well, then buy the Corvette, but at least you know what the actual cost of the Corvette is,
right?
Or whatever your big screen. It could go down to big screen TV. I remember a couple years ago, Dawn comes home. This is like now 10 years ago. She says, "I want to get red bottom shoes." And I'm like, red bottom? What? What do you mean red bottom? What the heck is red bottom? I never heard of it. And it was Christian Louboutin. She said, "Well, he's a designer, blah, 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 Paris, whatever." I'm like, "What? I buy my shoes at Marshall's."
First of all, Hunter, have you ever heard me talk like that? Ever?
Stop bringing Hunter into it. You're always
I don't talk like that.
It sounds like that to me,
okay.
Bossy Pants. So she goes, so she says, "Yeah, no, all the girls at the club have," but she doesn't really say that, but it sounds funnier.
Because I'm such a fashion designer dresser.
Yeah, well, I shop at Marshall's, which is a high-end,
I do too. That's why I've seen you.
I like Marshall's.
I do too.
It's the best value ever.
I agree.
Anyway, in our show. But I said that on Fox Business Network one time.
You did not.
With Stuart Varney. I did.
You said.
Stuart Varney said, how rich are you? Remember that? We were in New York on the set. And Stuart Varney said, "How rich are you?" I said, "You got to be kidding me. I'm a small business guy." I said, "I shop at Marshall's." I thought he was going to kill me.
Yeah, I remember.
I was on that show so many times.
I wanted you to turn to him and say, "How much do you make?"
He used to get really mad at me on
he
air.
did, yeah.
Because I wouldn't say what he wanted me to say.
Right.
You know,
Right,
and then
right.
he was a nice guy.
I wish you'd have turned to him and say, how much do you make?
Yeah, well, you got to be careful.
Of
You're the
course not.
guest. I'm the guest. He's the host. I was on that show 20 times in
I
1
know,
year.
I know.
So I got to be careful. And but I have been on it for a while. But anyway, so red bottom shoes. So I look them up. Okay, Christian. I forget actually in the real story. She didn't really say that, but something about Christian Louboutin came
I just
up.
had a special event, and
Special event,
and they had some really cool shoes that would match my outfit. And ladies,
that's what it was?
understand. Yeah, it was. I was going to a formal, and I wanted the shoes to match a gown.
Oh.
A gown that.
So they have to have red bottoms? How does that match the gown?
No,
with
it
the
just
bottom
happened
of
to
the shoe?
match the.
It's a bottom of the shoe. How do you see this? Some people looking at
And just so you know, it rubs off. It doesn't even stay on.
It does? I can't. Don't even tell me that after I bought those crazy shoes. $900 for
Not
these
all
shoes.
of it rubs off.
$900
Totally
freaking
worth it,
dollars.
ladies. It made my outfit.
Yeah, women
totally
all know
worth it.
red bottom shoes.
Totally worth it.
It's crazy. You guys
Well,
all
there are
you
other.
go to this school or something.
They're
They teach you all these things.
they're very comfortable.
Oh, I'm
they're
sure they
high
are.
heels.
They better be comfortable. My Marshall shoes are comfortable.
Did you have a
$900 for shoes? Are you out of your mind?
Did you have a point with this story?
My point is the actual cost of the shoe $900, or is it more because if you put it the same thing with compound interest? So now the effective cost over years is probably in the thousands. Well, certainly in the thousands of dollars. Actual cost.
Yes, but my happiness was worth
Your
the $900.
happiness.
Yes,
I'm very happy at Marshalls, and I get shoes for $35.
And you know
I'll
that's
paint
what-
them red. If you buy them
Oh,
there, I'll
come
paint
on.
them.
You know, I don't shop
I'll go to
like
Home
that.
Depot and get a can of red spray paint. I'll paint them red. You can tell all your friends they're red bottom shoes.
I don't shop like that normally.
Luckily for me. Anyway, so you guys get the idea. So, matter of fact, you know what? If you guys don't have a financial person, and you want to read this book, and you're not a financial person yourself, we get financial.
Do
people
not
on
give this book
podcast.
out.
I'm
Do
gonna
not.
give it to
Do
them. But
not.
You can't be a
do not.
financial person.
Guys,
'cause you
don't
get your own book. as a
Don't
financial
email me.
person.
I'm not sending it. And
I
Steve
will
doesn't
send
know
you
how.
a free book.
Steven doesn't know how.
Don't tell Dawn.
Yeah, Steven, you don't know how to do that.
I can send. I'm
Steven, you know how
going
many
to the
people
post
we're gonna-
office. I know where it is.
Do you know how many people we would have to
I
send
have
that
my
book
own
out
car.
to?
I can do it. What?
Okay, y'all heard that. Steve Siebold will send you a free copy.
I will put it in an envelope and mail. I know how to. I used to do that years ago.
Okay, Steve
It's been a while.
Siebold will send you a free copy if you will let us know that you want a copy of this book.
But you can't be a financial person.
Don't be a financial.
We get insurance agent, financial people. Oh, send me a book. Buy your own book.
Amazon.
Amazon, $17. But if you're not and you want help, I'll send you a book. Dawn will probably package it up though.
Nope, y'all heard it. If you don't get the book, you're gonna know why.
Anyway.
because I said no.
I was going to say study compound interest. You really don't have to. Just read this book,
Right.
okay? I mean, honestly, and if you're so inclined, honestly, I mean, just for fun, pour a glass of wine one night, and write down the 5 things you want to buy next. Get it on your computer, or your phone, whatever, and go to the compound. Type in Google free compound interest calculator. Just compound interest calculator, and plug in the number and a percentage rate that you think you can get. And if you're working with a financial person, you're going to get 8-10% if they know what they're doing. Okay,
Right,
you should in returns, even conservatively. All right, so plug in 10%. That's some annual average market return.
It's easy to figure out, too.
10%, and let the calculator figure out, and then say this over 5 years, over 10 years, over 20 years. If I kept this, whatever you're going to buy, but I didn't buy it, I put this into an instrument, how much money would it have? That's the actual cost of what you're buying. The real cost in the real world. And again, just to bring this all the way home, do that and you'll be blown away. You won't be able to sleep. It really throws you off. You start thinking, do I really need the new big screen TV? Do I really need the new model car or phone or whatever? And again, if you got more money to know what to do with, then fine. But for the rest of us mere mortals that have to watch money, it's a great exercise. It really is. So and again, bringing it home to a relationship is really about talking when you're negotiating back and forth or whatever you want to call it, discussing investments in a business, which you're always discussing, of course. Discuss it in real terms. These are the real costs, the actual costs of this money, this capital expenditure you're about to make, and discuss that with your partner. Now, can we afford it? The Corvette at $100,000, that's a lot of money. The Corvette at $200,000, that's a Ferrari, or not a Ferrari probably, but that's a lot more expensive car. So if you can afford the actual cost, God bless you, go buy it, but it's a totally different conversation when you
Totally
say
different.
It really is.
And
now you're really operating at a higher level the way really millionaire entrepreneurs operate.
Absolutely.
Yeah, it's different. So anything else about compound interest?
Nope.
Okay. We'll talk more about, we're going to go into greater depth. You're right. We probably should spend a show on each.
Oh my goodness! What did he just say?
So you're so
We have it on
irritating.
tape. You don't even have to say
You're just so irritating.
We got that on tape.
Yeah, it's
We're
really,
good.
we'll cut this part out. All right, guys. Thanks for watching the show, and we'll see you next time.
Bye-bye.